Welcome to our short view series on corporate governance in emerging economies. My name is Tom Kirchmaier of Corporate Governance at LSE, and I have with me here Nimesh Kampani, who is chairing the Committee on Financial Markets for the Confederation of Indian Industry and is also chairman of JM Financial. Nimesh, everybody talks about corporate governance in emerging economies. That's a big issue. What are the big issues in India?
I think in India, we have gone through a lot of ups and downs in the past. And there were 3 committees which were formed by the various authorities, 2 by the Securities and Exchange Board of India, of Mr. Birla and Mr. Narayan Murthy. And later on, CII formed a committee of Adi Godrej with Ministry of Corporate Affairs. And CII produced the first governance report way back in 1998. And thereafter, the government now in 2013, Companies Act have amended and brought in a governance in a very elaborate manner, and Securities and Exchange Board of India has brought for the listed company on the stock exchanges, as clause 49 of the listing agreement, and they have brought in elaborate governance policies, which is to be adopted by the corporate sector.
So is everything all right, or what are the big issues we are facing?
No, we have gone through a lot of processes, and I think the corporate sector was initially very upset because they were feeling that they have been burdened with a lot of more responsibility, and especially the independent directors of the company. Say now the governance structure now is that all the listed company in particular, requires, preferably a chairman and the CEO role to be different. And if the role is common, that means CEO and the chairman is common, then you need 50% of the total board as independent directors. And therefore, the minority interest protection is the very important measures which the SEBI prefers. And therefore, the responsibility of the independent director has gone up manifold. Like, now we have a remuneration committee, compensation and remuneration committee. Audit committee has been given a lot of tasks to perform, and which is statutorily defined in the Companies Act, and you require a stakeholders committee, and risk management committee. So, all these are formal now, under the Act or under the corporate governance code of the SEBI. Also, there are a lot of issues which SEBI has now prescribed on the related party transactions. And in some of the cases, the promoter group, which is also defined by the SEBI now, cannot participate in a general body meeting to vote, in a sense that if they are interested party themselves, on those resolutions, only the minority shareholder has to vote. And this is especially true in case of mergers, acquisitions, or any transactions with the promoter group companies by way of a loan or advances. And all those issues, the management promoter group cannot vote themselves.
So this is actually a very strong minority protection mechanism, really, which is put in place.
Yes, absolutely.
Is it working?
It is, because this is very new, because 2013, 1st April, this code has come into the picture. So, we are just 2 years old in all those things. And there is evaluation of our directors has to be taken place by the board, by the chairman, and every individual director has to be evaluated that what, his performance in the board. So it is a good thing from the governance point of view. It will get evolved, it will take some time, but one credit I must give it to the government and the Securities and Exchange Board of India, that they are very concerned about the minority shareholders.
So this is very interesting. You talked about 2 issues here. The first one, the role of the board and the functioning of the board, and then the protection of minorities. So I understand the protection of minorities is very important because you have a lot of dominant groups, family groups who supply a lot of capital, and then you have always this idea about related party transaction. Which brings me to the third topic, is about the role of the courts in this respect. You know, courts are very important in a UK-US environment. You have an act which can be enforced in court. How do courts work here?
No, see, we have a different courts. You know, for example, you know, session court, and then it goes into the High Court, and then goes into Supreme Court. So, only thing I must say about the courts in India is this, that it's a lengthy process.
Mm-hmm. Which makes it very expensive and probably not practical.
Yeah, many a times, you know, I feel that justice delayed is justice denied.
Yes,
you know?
I would agree with you on that one.
And we have seen cases, decisions comes after 10 years and 5 years and 20 years also. So what, the courts are very busy because there are too many cases. We are 125, you know, billion people, you know, and this makes lot of cases happening.
Of course, but you know, clearly the courts are understaffed for what is required for them to do. So, which brings us back to the boards. You know, so if you can't enforce any issues in court, you hope that the board is picking up on it. And you said quite rightly, you did a lot of work in the various governance codes on improving the functioning of the board. Then the big question is, so what is happening in these boards? Are they really taking it serious, or is it just a box-ticking exercise?
No, the liability of directors have gone up substantially high, you know, and because of this, the boards are taking this very seriously.
So they're standing up for the rights of the shareholders?
They are standing up for rights for shareholders. They are demanding from management. They have been insisting on certain procedures and process, you know, to be beefed up and maintained. And I personally believe in the next 10 years' time, it's excellent for India to do this, because this will create a slowly self-regulations by the board and the companies, because you know there are whistleblower policy, you know, and there are you know policy by the options, stock options. So I think there are various things which are happening. So first 5 years is a period where you know you go through all this process and you have all the problems and all those kind of things, but you know after that you know you churn. Also SEBI has another good thing, that you appoint independent director for a period of 5 years, and they can only have 2 terms. It's not that independent directors can continue for 20 years and 30 years. Like in India, you know, I am a director of a company for maybe last 20 years. And if I want to also go from the board, the management doesn't want me to go. Or the promoter doesn't want to go.
You're part of the ecosystem now, but so, it's good in a way that
so the point I was making is this, that there is always a possibility of a change after 10 years. Even the auditor's appointment cannot be for more than 2 terms, for 5 years. So, you know, there is also change in the auditor. Responsibility of the auditor has gone up substantially, you know, under the governance code.
I think it's fair to say, listening to you, that the standard you have in India is almost the same, if not superseding the standard in the US or the UK in terms of governance.
I think we have taken from there a lot of things, you know, and I think we have made it more tougher, because now this code is also applicable to private companies, which are many times a family-owned companies.
So this is interesting. So even if you're not listed on the stock exchange, you're still subject to these rules, is it?
Yes, you know, you require independent directors in a privately family-owned companies. You know,
is there a certain size threshold, I assume, you know, above certain?
It's about 10 crores of rupees, which is about say $2 million net worth of the company. And you know, the Reserve Bank of India has also put a substantial rule on all non-banking finance companies, which are, you know, which you have to report every month to the Reserve Bank of India. So I think this structure is happening. But I would like to take you to another point. This all we talked about private sector. We need to talk about public sector. Because in a public sector also, the government in most of the companies are majority shareholder.
So you mean state-owned enterprises?
State-owned enterprises. And I think reforms there are required, in a sense that, I think this government, has started this. For example, our state-owned banks, they always were internal appointment of the chairman and the managing director. The first thing this Mr. Modi's government has done is to now make chairman separate, CEO separate in the banking sector. They have invited the public sector banks to have the CEO from the private sector. So that process is just now going on, and the government is thinking about appointing the best available person to run those banks.
Do you think they will privatize them soon, or?
I don't think there is intention to privatize at the moment, but they are encouraging them to raise capital till the government remains at 51% holding. So they are allowing them to dilute. Like State Bank of India is going to raise substantial money, through the either public issue or QIP issues, from the public. And this is the largest public sector bank of India. But the point I am making is this, that if this governance applicable to all the public sector undertaking, and the governance standard are improved, then the efficiency of those companies also will substantially improve, And
I fully agree with you, because this is why we're doing it, this is why we're talking about it, is on the one hand to improve efficiency of the firms, but also to protect shareholders, so they're willing to lend. Which leads me to another question. Now you're a capital markets professional. Do you see actually an impact on the ground in terms of cost of capital for firms?
What we need in India is to build a lot of infrastructure. And for that we need a lot of capital. Historically, if you really look at between India and China, India has liberalized capital market much faster than China. After the liberalization process started in 91, 92, there onwards, the simple rules are made for FII, foreign institutional investor, to invest in India. And then they can repatriate the capital. So it is a partly capital account convertibility has taken place for outside institutional investor. Now this has been extended to any foreigners. There is foreign portfolio investment. That means you can invest up to 5% of equity in any listed company in India by a simple process of opening a brokerage account, and trade on the Indian stock exchanges and repatriate your money, whenever you want to do that. There are no restriction on repatriation. So this is the process, which is substantial liberalization compared to, the other countries in the world. And today, the best of the banks in India, for example, ICICI Bank or HDFC, Housing Development Finance Corporation, is about 74% owned by the foreign institutional investors. And there is a widespread shareholding pattern which is developing.
But each one is not allowed to hold more than 5%, is it?
10%.
10% in this
Yes,
case.
yes.
Yeah. So coming back to my initial question on, do you see actually an impact on cost of capital?
Oh yes, because, basically if you really look at, let me go back a little history, that the tech company, IT companies like Infosys and Tata Consultancy Services, TCS, Wipro, when they came into the market and where the governance systems was very well done up by their boards, like Mr. Azim Premji or Mr. Tata or Mr. Narayan Murthy helped doing this at that point of time, you got a better valuation of those companies, which means whenever you are raising more money, your cost of capital is lower and lower and lower on that basis. And therefore, one thing which industrialists and the public noticed in India is that if you have better governance, your shareholders' value goes up and your rating goes up. And when your rating goes up, your capacity to borrow or to raise equity and the cost of capital, weighted average cost of capital also comes down.
I agree with you. Nimesh, many thanks for spending time with us today and having this very interesting conversation. And many thanks to you, our viewers, for watching our short view on corporate governance in emerging economies.